Hello everyone and welcome to Moementum channel and another stock analysis video. My name is Mo, and in this video we'll take a look at two undervalued stocks that are available in the stock market right now. These stocks are showing an upside potential of over 20%, and one of them is a dividend paying stock. I think you're going to find this video beneficial because not only I'm going to introduce these two stocks, but also provide a step-by-step walkthrough of how I go about analyzing these stocks and determining what their true value is. Watch this video until the end and let me know what you think. The first undervalued stock to review is Biogen, which is traded on NASDAQ stock exchange with ticker symbol BIID. It was last traded at $243.36, but it is showing a fair value of $320.04 based on its real or underlying intrinsic worth. This shows an upside of 31.5% growth, but with a medium level of uncertainty, making it an enticing undervalued biotechnology stock in the healthcare sector to buy or add to your watch list right now. The fair value is calculated based on Finbox fair value methodology and allows investors to identify companies that are being traded at a margin of safety compared to their stock valuation per share. The Biogen stock is showing a forward price to earnings ratio of only 7.29. For your reference, forward price to earnings uses forecasted earnings for the price to earnings calculation. It is used to value companies at their future level of earnings. A lower forward price to earnings suggests that the company is being traded at a cheaper valuation. You'd notice that the stock's trailing 12 months price to earnings is currently sitting at one of the lowest levels it has been over the past 5 years. This suggests that Biogen's current stock price is relatively one of the cheapest prices it has ever had in the stock market. To put things into perspective, we've compared Biogen to a number of its competitors in the same sector, in companies such as AbbVie, Amgen, Gilead, and Illumina. This comparison on Finbox shows how Biogen is relatively the cheapest stock based on a comparison of the stock price to company's book value as well as the price to earnings ratio. Looking at Biogen's financials, we notice that the company's trailing 12 months revenue is at $14.3 billion, showing a decline compared to previous 2 fiscal years. Similarly, their net profit has been declining, showing a trailing 12 months net profit of $5 billion compared to $5.89 billion net profit in the last fiscal year. We believe that these declines have been already baked into the stock price of Biogen. Ideally, we would like to see a company that is continuously increasing its revenue and net profit. Nonetheless, a decline of 1.5% in the revenue trailing 12 months for Biogen is rather an insignificant decline, which we can look past given the unprecedented times last year. As for company's balance sheet, their current assets well exceed their current liabilities over the past several years. This results in a current ratio of over 1, suggesting that the company has enough financial resources to meet its short-term obligations. Moreover, you'd notice that companies' total assets also well exceed their total liabilities, which is a positive indicator and a healthy sign on company's balance sheet. Looking at company's cash flow, you'd notice that the company is showing a positive free cash flow, mostly generated from its operations, which is another positive sign to look for here. Moving on, and if you look at the peer benchmark review, you notice that Biogen has a market cap of over $37 billion. The Biogen stock had a 1-year stock return of negative 15.8% compared to an average of 5.2% positive return for the healthcare sector. The considerable decline in stock price has definitely led to making the stock price cheaper compared to a lot of the other competitors. From a stock volatility perspective, this stock has a beta of 0.49, which is a lot less than the beta of 0.78 for the healthcare sector, suggesting lower levels of volatility in the stock price for Biogen compared to the sector median. Beta is a measure of volatility or systematic risk of a security or stock compared to the market as a whole. A beta of less than 1 suggests generally less volatility in the stock price compared to the overall market. Biogen is an American multinational biotechnology company based in Massachusetts, specializing in the discovery, development, and delivery of therapies for the treatment of neurological diseases to patients worldwide. Biogen does not pay a dividend at this time. Looking at Biogen's last quarterly earnings report, which was announced on October 21st, 2020, the company had earnings per share of $8.84, which showed a 9.8% positive surprise compared to analyst estimates. The company reported revenue of $3.4 billion, which slightly surpassed analyst estimates by 1.1%. The date for the next quarterly earnings report is yet to be announced, but the company is estimated to report revenue of $2.79 billion and earnings per share of $4.77. Though majority of analysts have lowered their estimate of earnings per share for Biogen over the last 90 days. You can see at the bottom left graph how the stock price has reacted after earnings report. Within the past 10 quarterly earnings time, the company's stock has decreased 7 times after the earnings report was announced. This is despite the fact that for Biogen, they have surpassed analyst estimates both in terms of revenue and bottom line earnings per share in all of the past 8 quarterly earnings. The second undervalued stock to review, which is in consumers staples sector, is Kroger. The stock, which is listed on New York Stock Exchange with ticker symbol KR, was last traded at $31.59, but it is showing a fair value of $39.05 based on its real or underlying intrinsic worth. This shows an upside of 23.6% growth with a medium level of uncertainty, making it another enticing undervalued stock to buy or add to your watch list right now. The fair value is calculated based on Finbox's fair value methodology and allows investors to find companies that are being traded at a margin of safety compared to their fair valuation per share. Looking at Kroger's financials, we notice that the company's revenue has been steadily growing over the past several fiscal years. Their trailing 12 months revenue is at $130.7 billion, showing a 7.4% increase compared to previous fiscal year. Kroger's net profit is also growing steadily, which is a great sign. The trailing 12-month net profit for Kroger is at $2.99 billion. As for company's balance sheet, their current liabilities exceed their current assets, which is not ideal. This results in a current ratio of less than 1, suggesting that the company may not have enough resources to meet its short-term obligations. While this is a little bit of a red flag, company's total assets well exceed their total liabilities, which is a positive indicator. You'd also notice that the company has been able to lower its total debt in the trailing 12 months compared to past fiscal year. Kroger is also showing a positive free cash flow of $3.69 billion in the past 12 months, mostly generated from its operations, and that is a positive sign for us to see. Looking at peer benchmark review, you'd notice that Kroger has a market cap of over $24 billion. Kroger had a one-year stock return of positive 13% compared to an average of 0.7% return for the consumer staples sector, showing an outperformance compared to the consumer staples sector's performance as a whole. From a stock volatility perspective, Kroger stock has a beta of 0.34, which is lower than the beta of 0.46 for the consumer staples sector and the beta of 0.67 for the company's peers, suggesting less volatility in the stock price for Kroger compared to the sector and its peers. The Kroger company is an American retail company founded in 1883 in Cincinnati, Ohio. It is the United States' largest supermarket by revenue and the second largest general retailer behind Walmart. The company operates a number of different chains and brands, as you can see on the screen. Kroger does pay a dividend that is currently yielding 2.27%. The company has increased its annual dividend payments every year for the past 15 years. Looking at Kroger's last quarterly earnings report, which was announced on December 3rd, the company had earnings per share of 71 cents, which showed 8.3% positive surprise compared to analyst estimates. The company reported revenue of $29.7 billion, which slightly missed analyst estimates by 1%. The date for the next quarterly earnings is yet to be announced, but the company is estimated to report revenue of $30.7 billion and earnings per share of 68 cents, though majority analysts have increased their estimate of earnings per share for Kroger over the past 90 days. You notice here how the stock price has reacted after earnings reports for Kroger. Within the past 10 quarterly earnings reports, the company's stock has decreased 7 times after the earnings report was announced. Looking at the actual earnings report and comparing it to analysts' forecasts in the past quarterly earnings, you'd see that over the past 8 reports, Kroger has surpassed analyst estimates 6 out of 8 times for their earnings per share, but missed analyst estimates in terms of revenue 5 out of 8 times. How companies miss or exceed analyst estimates plays a huge part in how the stock price reacts after the quarterly earnings is release. Nonetheless, that's not the only factor, and there are a number of other factors involved. Things such as the guidance of the company and where they see their business headed in the future, or how the stock has reacted and returned over the past several months or weeks prior to quarterly earnings reports. Lastly, I wanted to mention that both of the companies we reviewed here have a Piotrowski F score of over 7, which is desirable. For those of you who are not familiar, the Piotrowski F score metric is a number between 0 to 9 used to evaluate the strength of a company's financial position and identify best value stocks. There you have it, folks, my 2 recommendations of undervalued stocks to consider to buy or watch in the stock market right now. Please know that while I've done extensive research to put together this video, I'm not a financial advisor, and you should never buy a stock just by listening to a YouTube video. Make sure you to do your own research and do your own due diligence and make your decisions after that. With that being said, I hope this video was beneficial and provided you with some value. If you found this video helpful, please be sure to give it a thumbs up and share it with someone who might benefit from this video as well. And please don't forget to subscribe to Moementum channel. Here on Moementum, we post weekly various videos about stock market analysis, investing, finances, and financial freedom. Thank you guys, and I hope to see you next time.